What's up, you guys? Mighty Mike here for another episode of the Mighty Mike Show. Today's guest is going to just blow you guys away. Don't go anywhere because you guys are about to save millions.
What's up, guys? This is Yonah Weiss. You are listening to the Mighty Mike Show. Let's go!
Yes, I love it. Welcome to the show, my friend.
It's my pleasure. That's probably one of the best introductions I've ever seen. I gotta steal that from you.
Well, listen, I am just honored that you took the time to come on the show. Johan is a powerhouse with property owners and tax savings. Assisted with clients with saving tens of millions of dollars on taxes through cost segregation. So we're going to dive into that today, you guys. If you're watching online, comment below. What are your questions for Johan? He is going to, I'm sorry, Jonah. I keep calling Johan. I'm sorry, my friend. Oh, Johan. Anyway, so I'm sorry about that, but listen, you are going to bring some major value today, and I am just super excited about it. Welcome.
It's all good. Yeah, totally fine. The name happens, quite a few times, so totally used to that. It's all good. It's Yonah. It sounds like Jonah, just with a Y, so pretty easy. But happy to be here. It's great to be joined on the Mighty Mike Show. Love it. Love the name. And let's just jump right into it.
Yeah. So take a minute. Tell us a little bit about yourself and your personal life.
So a little bit of myself. I mean, besides for the business, obviously, I'm a father of 6 kids, really amazing. Oldest 17, and youngest 7 years old. So a little mix of everyone right there at this time. No newborns anymore at this point. I was a teacher for many years, so I spent a lot of time doing that. Loved community work. I started a nonprofit many years ago to help families in need after struggling myself. And about 5-6 years ago, I found real estate, and it really has changed my life in a lot of ways. First of all, the biggest thing is that now I've been able to, through business and through investing in real estate and helping so many people through the process, as you mentioned in the intro, like helping people saving tens of millions. I probably have to update that bio because it's well over 100 million at this point, maybe hundreds of millions. I haven't calculated it, but this year has been an incredible year. I got involved in real estate and have been able to give back, and that's really the main thing. That's my biggest thing in life is how can I, success to me means how can I help other people? How can I give back? And that's one of the reasons why I love what I do so much.
Well, I love it. And I love, the whole idea of getting behind the scenes and getting into the gears of real estate investing. So many people, it's like finding a deal, which is important, funding a deal, which is important. All these things are like very surface level. But when you start to get into some stuff like cost segregation, all of a sudden that one thing that property tax that was going to make the deal not worth it anymore, now the deal actually might be worth it now that you can kind of finagle things and make it work in your benefit.
Yeah, it's huge. I mean, it really is a game changer. And people use that word all the time, but this is like one little tiny piece of the puzzle, a real estate deal that can literally change the entire game and change the entire strategy. I have tons of clients, hundreds of clients, people that literally pay zero income tax because of this strategy. So, you talk about, and we'll get into the nuts and bolts of it, but people talk about real estate investing and the tax benefits that come along with it. Like, this is it. Like, this is the main tax benefit that comes along with real estate investing, depreciation and cost segregation, which is just a form of that allows people to be, using the tax code legally to pay, little to no income tax whatsoever and scale their business.
So let's dive into that. So that's your specialty, guys. This is a master class on cost segregation. Tell me, I'm going to tell you what I know about it, which is very little, so that you can fill in the gaps and just like correct me and like make this just like an epic episode. First of all, I want to use the example of Donald Trump. Because he's a polarizing character, and it'll help us with our views. Right? Take a book from his page, right? So, a lot of people talk about how he paid very little taxes, but people not very often talk about how he did it because he paid a lot of money towards accountants and things like people like yourself to be able to use the tax code to his benefit with real estate. I mean, what do you have to say about that? I mean, do you know much about that?
Yeah, absolutely. I mean, that's one of my favorite quotes of all time. Is actually the only time I've known to quote myself, which is which is something I don't do it very often. But I came with this thing and I posted on LinkedIn a while back, and it just kind of stuck. It was like, real estate investing is great, like paying no taxes, just like Donald Trump, right? Because that's how he does it. He has leveraged, and he's a great example of that, because someone who is we call a real estate mogul. I mean, he made billions in real estate. He also lost tons of money and, did business. He had an airline that failed, tons of business ventures, but it was all using the tax code to your benefit. And depreciation is one of those things. And some people might like paint the picture like, oh, doing something illegally. And like, I remember years ago, the New York Times headline that read like Jared Kushner pays 0 in federal income tax, right? And it's all just, I mean, it's really out there to, like you said, to polarize, to get people who don't know any better and don't do the research to create the narrative in their head. Well, oh, these people are fraudulent and they're doing something wrong. When really, if you read the article, he's using tax strategies like 1031 exchanges and accelerated depreciation, cost segregation, that allows you to reinvest your money. And the government is incentivizing people like that to invest in real estate because it really does build the economy, and it gives back in so many different ways.
So understanding these kind of rules, and that they're, I love what is it? Robert Kiyosaki likes to talk about this kind of stuff. He's like, the rules for the rich are different.
Right.
And the thing is like, they're not really different. You just know about them. They just know about them. They take the time to know about them. And I guess maybe if they made a certain amount of money, now they qualify for these other things, right? Or they spent a certain amount of money, so they qualify for these things. But what it is they're putting their money in the right place to begin with, right? Instead of buying the Xbox or the, I don't know what it is now, PS10 or whatever they are, they're buying assets, right?
Buying assets, investments, and things that are paying you, not things that are liabilities. And I think the way that you put it is great. I mean, people who are successful are smart enough to know that they need a team of people and advisors that can help them navigate the tax code and the legal, all these things, so that they're doing stuff legally but taking advantage of that. And I think that's a huge difference between people who are super successful, is that they have, they don't mind paying a lot of money for really good accountants, really good attorneys, because that's going to, number one, save them a ton of money, save them a ton of hardship, a ton of time, but most importantly, that it's going to help grow their business, because those are the right investments. They're putting the money in the right places.
So you guys, I think you guys have gotten the gist here. This is important. And if you're in real estate investing, you can't afford not to know about this, right?
Yeah, 100%. And the problem is that most people don't know about it. And I think that's really the struggle that a lot of people have, especially when they're starting out in real estate. People have to start somewhere. And oftentimes when you're starting very small, maybe a wholesale deal, maybe a fix and flip. I know that's how I started. And you don't necessarily know about all these great, strategies that can help you scale, that may be relegated just for the, bigger, larger commercial real estate deals. And it's a problem, right? But you have to still educate yourself, which is why there are podcasts like the Mighty Mike Show and others, so many out there, that you can educate yourself, even though it may not be relevant to you right now, but you'll know what to do when you get there.
Yeah, I love it. So let's dive into some of the nitty gritty. So let's maybe use an example. What's your favorite example of an actual property, maybe one that you've worked on, that it would have gotten an X amount of dollars in depreciation, but instead it got this amount in depreciation? You want to do that? You want to go through that?
Yeah, absolutely. We can break that down. And we do about 3,000 a year, so it's hard to pick any one single property. But The gist of it is, and I'll just take a simple property like we're doing a lot of Airbnbs right now, single family, even though our main focus is on commercial real estate, but there's been a huge spike in the number of people investing in Airbnbs, short-term rentals, we'll call it, right, in certain specific vacation rental markets like the Smoky Mountains in Tennessee, or the Blue Ridge Mountains, or in Destin, Florida, and or these kind of places where they're very heavy tourist vacation location. And you can do an Airbnb almost anywhere, right? But we've done a lot of these, and I'll just give a simple example because you might think, a single family may not be as beneficial. So let's just take a certain example, right, of a house. Normally, when you buy an investment property, it doesn't matter what type of property it is, as long as it's not your personal residence, you get to take a tax deduction called depreciation. Okay, and it's not as bad as it sounds, right? Depreciation sounds like something's going down in value. Really, your property's not going down in value. It's a tax deduction, so it's a borrowed term. So the IRS, the income tax, right, gives you this tax deduction saying you just bought this property for $500,000, let's say. Just keep it simple, round numbers, and you can now take a tax write-off. Literally take that $500,000 as a tax write-off. But you can't do it all at once. What you're doing is you're taking it and dividing by 39 years, right? For commercial properties, 27 and a half years for residential properties, which means you can take 1/39th of that $500,000, which winds up being around $10,000, right? After you take off a certain amount for land, which doesn't depreciate. That amount, that's your tax deduction. Meaning, whatever income you make from your property, right? Let's say you made $50,000 from this great investment property, right? You subtract $10,000 right off the top. That's your depreciation deduction, and you're only taxed on the remaining $40,000. That's simply how depreciation works. Comes cost segregation.
That's basic
depreciation.
Everyone really does that, really.
Everyone should do that, right? Yeah. If you own an investment property, business investment property, whatever it is, if it's a rental property, okay, if it's a fix and flip or something like that, you don't get that because it's not a rental property.
Perfect.
But any rental property you have, you get this, and every accountant in the world knows about depreciation. What they don't necessarily know about is how the tax code actually defines certain components within a property that actually depreciate at faster rates. And this is the process of cost segregation. And you need a specialized engineer, right? Cost segregation companies like ours that specialize in this by breaking down the property into its elements from an engineering standpoint, meaning we're looking at it and saying, oh, well, yes, the structure, right? The walls, the windows, doors, roof, floor, foundation, all that stuff depreciates on that 39-year schedule, 27 and a half, right? For commercial residential. But what about all the stuff inside? What about the furniture? What about the appliances? What about the fixtures? What about window treatments? Things that are non-structural, lighting or cabinets, other things like that you're like, oh, wait a second. Yeah, those aren't structural. It's not, even though it may be attached to the wall, the final flooring, that's attached to the ground. But the IRS says in the tax code, it's something called the modified accelerated cost recovery system, the MACRS, and you can look that up, Google that, MACRS. It defines every individual component in a property and how it's actually supposed to depreciate on a fast rate. So all those things I just mentioned really depreciate on a 5-year schedule, not 39, which means you can take the value of those individual components as a tax write-off at a much faster rate, right? You add all that up, and when you look at a whole property and say, okay, I bought this property for $500,000, but all the individual components within it that depreciate on a 5-year schedule really add up to $100,000, right? 20% of the whole property. Guess what? Now you can take that $100,000 as a faster tax write-off up front. Instead of $10,000 a year, in the first 5 years, get $100,000. So you've basically doubled or more than doubled your depreciation deduction during those earlier years of ownership. And it's a huge strategy, essentially is what it is, allows you to take these bigger tax deductions to pay, like I said, little or to no income tax and help you scale on a much faster rate.
So let's break it some of the benefits down, because that was a lot and you guys can go back and listen to it. But let's move forward and let's break down some of the benefits that I heard right away and help me out, right? So the first one that really just stands out to me is that I may not keep a property for more than 5 years, right?
Right.
So
Exactly.
maybe I'm going to keep it for 2 or 3 or 4 years, and then it'll fall off my escalator of properties, and I've already gotten that $100,000 in depreciation up front. So when I turn around and sell it, I didn't sell it with all that depreciation that it would have gotten over 40 years. So that's
That's
one, right?
100% exactly. And I think that's the point is if you look at like this potential, this pool of potential deductions of that $500,000, that yes, you can do this on a single family, you can do this on any type of property. That pool of deductions, you may not even touch any of those, right? Because again, you're not holding the property for that long. But what if you can touch those deductions? What if you can bring those forward? And that's exactly what we're doing. We're accelerating those deductions, some of them at least, and bringing them forward so that you can use them.
So you keep touching on residential versus commercial. On a commercial property where there might be more fixtures, do you find that tends to be the case? There's more, I don't know, depreciating elements inside of a commercial building versus a residential, whereas yeah, you have a couple of appliances, but it's pretty much just the house, right?
You'd be surprised. I mean, there's so many different elements inside even a residential property. We do every type of property, whether it's an office building, retail, industrial, mobile home parks, you name it. Any type of property whatsoever can be depreciated and can have cost segregation. On average, residential long-term rentals typically have around 15 to 20% of the actual property accelerated into these faster depreciation categories. So yeah, sure, there are things like appliances and furniture, but there are also things like I mentioned before, the flooring, oftentimes the carpeting or vinyl flooring, all that value, window treatments, right? Blinds, curtains, things like that, fixtures, you'll have cabinets, countertops. If you have any type of wall coverings, a lot of times you'll have that, you name it. I mean, really the list goes on and on. There's over a dozen categories of things that will fall into those faster depreciation schedules.
Wow.
And then outside the property, you also have what's called land improvements. And land improvements, that's not land, but anything on top of the land, like landscaping or pavement, concrete, asphalt, anything, fencing, signage, if you have a commercial property, obviously signage. All that stuff actually depreciates faster, like a patio or a swimming pool. The value in that concrete actually depreciates on a 15-year schedule and allows you to take those deductions faster.
Wow. Okay. So I love, flipping and wholesaling and doing all that, any kind of real estate investing, right? So let's say I get a property that's bare bones. I mean, it's a skeleton, right? And I got to put in flooring. I got to put in the things I hear you mentioning are the things I always have to fix.
Right.
Right. The countertops, the cabinets, the flooring, the anything outside, like you said, other than the even maybe like laying some new concrete, what you're saying can be 15 years instead of 30, 40.
Exactly. Yeah. So when you're doing a renovation, so you can actually get the benefit on the money spent on renovations. So your depreciation is totally based on the purchase price. So even if you buy something very undervalued, your purchase price is going to establish that depreciation basis. Meaning the amount that you can take as a deduction over that long period of time. But when you go and spend more money and do upgrades and do renovations, like you said, putting all those elements in, you can depreciate, or you should depreciate all of that stuff as well, which means you can take that as a faster depreciation deduction if you analyze and say, okay, well, I'm putting in carpeting, I'm putting in countertops, I'm putting in all this stuff. You can depreciate that at a faster rate, and you can take what's called bonus depreciation. And so this is something I didn't mention before, but we'll just cover it now. It's a new tax law that allows you to take the deduction of any accelerated deduction, meaning the 5-year property, the 15-year property. You have the option to take all of that in the first year as one big lump sum. So it's that's really why it's like the biggest thing recently, especially when this law came to being a few years ago, that allows you to take this huge lump sum of depreciation up front.
That's crazy. How do you oh, wow. So that is insane. So you take all this depreciation up front. So if you're flipping properties, you're listening to this right now, and you had to write a big check to Uncle Sam, how can that guy who's just like, what? I had to just send a $40,000 check to Uncle Sam for just a couple deals that I did last year. How can they get started? What are 3 things you'd recommend somebody do to get started with cost segregation? Obviously, they need an expert. We got you.
Right.
But so what are things they need to consider?
I mean, the first thing you need to do, if you're a flipper, if you're a wholesaler, if you're a broker, you're involved in real estate full-time, but you're doing transactional real estate, as I like to call it, like the things we just listed, you're not going to benefit from this greatest tax deduction called depreciation. The way you need to start is to buy a rental property or invest with partners or in a syndicated, whatever it is, buy a rental property. Now you get to take that depreciation. So when you're doing that, you get to now use those accelerated depreciation deductions, that bonus depreciation like we just mentioned, not only to offset your income that you're getting from that rental, but if you're a real estate professional, you get to use that against all that other income. So I know a lot of people who are wholesalers, who are brokers, who are flippers, and they also make sure to invest in rental properties, at least one or two, because so that they can get specifically to get those extra deductions. Because otherwise, like you said, you're being taxed at the highest rate, number one, and you're cutting a big check usually at the end of the year, which that's no fun. I mean, you want to be able to keep the money, right? Like Robert Kiyosaki, you mentioned before, right? He said, it's not about how much money you make, it's about how much you keep.
Yeah, I love that. I love that. So to touch on the flipping versus the renting, what if I'm flipping? That's how I'm creating cash flow. I'm basically have a job, right? Like, as Kiyosaki would say, like I have a job. I'm flipping
Right.
houses,
Right.
and then I'm buying rentals over here. Is it always? And this may be an ignorant question, but I gotta know. I gotta know what I'm able to do here. And guys, this is not any kind of accounting advice. You need to seek, professional accounting advice, but um, this is just for entertainment purposes only. Okay, so that's the charm you get. All right, all
And
right.
I'm not a real CPA. I just play one on Facebook Live, right?
Yeah, exactly. But so yeah, I'm flipping houses. I want to rent. I want to invest in rentals. Is there a way that I can then take what I would have paid from this house and cost segregated these rentals over here to offset the income I would have to pay on the flips?
Yeah, that's exactly what you can do. So any rental, if you are a real estate professional, which means your full occupation is doing, whatever those activities are, doing construction, brokering, right, buying, selling, whatever it is, you managing, operating, all that stuff, you can use the depreciation deductions, those tax deductions, to offset any income that you have.
Any
Okay,
income.
so it's
Oh,
not just limited to the rental income, and that's really where the game changer is. And that's exactly what I'm talking about.
yeah.
Buy a rental property because those deductions can help to offset the higher income from the fix and flips, which can, like you said, that's the cash flow. But if that cash flow is being bitten into from the income tax, then it's not true cash flow, right? I mean, it is, but it's being reduced by that income tax. Well, how can you reduce that income tax liability? By getting more deductions. How do you get more deductions? These losses, these tax losses. The biggest way is through doing cost segregation on a property. Now, you may not necessarily have a rental property, but you got to realize this is the way to do it.
I love it. Okay, so let's dive into the real estate professional. So I'm a real estate professional, but I'm probably not, right? What do I have to be an official real estate professional?
So this is the IRS's definition, and it's something that is straightforward from the tax code. Meaning, if you write on your tax return where it says that line where you write occupation, if you write real estate professional, which if you do that, you now get like this super status, right? Which allows you to take these deductions, this depreciation against your active income, any income you will. But how you define by that? If you spend the majority of your working hours doing any real estate activity, so that means managing, operating, construction, right, renovations, acquisitions, right, brokering, any of those activities that's involved in actual real estate, you are a real estate professional. Now, you cannot have a W-2 job and also be defined as a real estate professional unless that W-2 job is involved in ownership of real estate, right? Meaning you can't just like work for a property management company, but you don't actually own any of the equity in that property. I think you have to own at least 5% of the equity in order to be considered that real estate professional. However, the other caveat is that your spouse can be a real estate professional and you can jointly get that status. Meaning if one of a couple is a high income earner, let's say they're a doctor, lawyer, whatever it is, high professional, IT, whatever it is, and the other one is a real estate professional, you can now use you get this benefit of using depreciation to offset both of your incomes combined.
That is powerful. That is powerful. So I think I was just getting excited, so we got off track a little bit, but like, what are some other things that they need to do to like get started like right away?
Yeah, I mean, the educating is the first step, right? Obviously, the first step is always education, learning about what this is. To know and reach out to me, we always provide a free feasibility analysis of any property. So you're like, okay, well, how come, is my property even qualify? Is this something that I can even benefit from? You know, I'll be able to tell you right away. Meaning, send me the information. I'll tell you, okay, this is the amount you can expect, right? This is how much it costs to get the cost segregation study done. The free feasibility analysis we do, all the time. Feel free to reach out. You can find on my website, LinkedIn, wherever you want to find me, Linktree, Instagram, wherever you find me online, you can find a way to fill out a feasibility analysis form. The other thing you want to do is speak to your accountant. And this is something a lot of people don't realize, right? Having a good accountant when you're in real estate is worth its weight in gold, because there are so many of these strategies like cost segregation. I mean, obviously that's a big one, but there are other things that you may be missing out on if you don't have a good accountant, because most accountants are just, and I'm not an accountant, we don't do tax work, we just focus on the cost segregation. So you want to make sure that your accountant knows there's such a thing exists, okay? And so you want to make sure, have a conversation and say, are you just collecting all the information and inputting it and filling the tax forms, or do you have any advice for me? Any strategies, any ways that I can look to reduce my tax liability, any type of write-offs I can do, any type of things like that? Because like I said, it's worth its weight in gold, because if you have these strategies out there but don't know about them or are not taking advantage of them, what benefit does that do?
Yeah, that's true. That is so powerful. And so, like, you got all this stuff going on with cost segregation, but we're really diving in on it here, and I feel like we've kind of gotten the meat and potatoes of it. But is there anything else when it comes to cost segregation that you feel like we haven't went over?
I mean, those are the main things. I think we did discuss a lot. Obviously, there's so much more to learn, but the main thing is that if you're holding a property very short term, okay, so if it's a fix and flip, something like that, you don't get depreciation. You can't take it. Again, it's just for rental property. The process is pretty simple, pretty straightforward. It involves engineer walkthrough of the property, which means we're able to identify all the individual components and create this very detailed report, and then make a new depreciation schedule. So instead of just lumping everything together like your accountant would do on a 39-year or 27.5-year schedule, you can now take these different line items where you can take it all up front, take a big portion of them up front. On average, I'd say, like we mentioned before, residential properties about 15, 20%. Other types of properties may have up to 30 or 40% of accelerated depreciation, which means if you buy like $1 million property, I mean, you could very well have like a $200,000, $300,000 tax deduction just from doing that, which is incredible because it's based on the purchase price, not on how much money you put in. So you may buy a property with 20% down loan, right? And you're basically getting that year a tax deduction for the amount or even more than you actually put in your equity.
Yeah, that is so powerful. Yeah, understanding these tips and just the way that, well, first of all, in the first part of the show, I always dive in, especially on these master classes, like why? Why do we even need to worry about it? So if you've been listening to this and you are still like, I don't get it, which I totally understand, because the first 10 times I heard people talk about it, you've explained it very well, broke it down very nice. So if you guys don't got it, go back, listen to it again.
Listen
He
again.
explained it very well, very well.
Appreciate
And so,
that.
yeah, so a couple of the things I want to dive into here, something I always love to ask my guests, we're going to dive into, and I call it the Mighty Flex round. So we're going to dive into that right after a word from our sponsors. And I'm actually just going to say the sponsor. It's, let me do a screen share. We are going to show Mr. Let's see here, PropStream. Boom. So PropStream is my favorite deal. Guys, just go check it out. You can actually search and get all your leads. If you're a realtor, you can actually get MLS leads. You can get pre-foreclosures. You can get vacant lists. You can actually analyze your deals right on here. Have you ever heard of this?
I haven't. No, this is the first time I'm hearing about it and getting a live demo over here. It's great.
Yeah, exactly. Yeah. And so, I just have an affiliate link people could click on. I barely get anything. So if you don't want it, that's okay. I love it. And it helps me find deals all over the place. And so I'm super stoked about it.
Nice.
Guys, welcome back to the show. Are you ready to do some mighty flexing?
Let's do it.
All right. So what? So just you're an industry mogul. All right. I've seen you all over the place at all these different conferences and doing stuff online. I've been watching you online, and you are the cost segregation guy. I mean, I almost want to say you should change your name on social. um, but you're also a real estate investor yourself, correct?
That's right. Yeah.
So one of the things that people are always trying to do, this is more surface level stuff, right? But finding deals. I showed you PropStream, how you can find deals on there. What is your favorite way to find new real estate investments?
So for me, everything really comes down to relationships. That's what it's all about. I mean, I don't, because of my main job is based in what I do, and I do a lot of online, a lot of networking, and like you say, going to events and this stuff. It's all about networking. It's all about relationships. So for me, the best way to find deals is just through relationships. Whether it's through brokers or other investors. I've focused on a lot of passive investing recently, just because I don't have the time to spend on that, which is a great way to kind of leverage, if you don't have the time, leverage the capital, leverage someone else's experience. And so again, it all comes down to relationships. But yeah, definitely looking for deals. I'm actually looking for an Airbnb property right now. So if anyone's watching this and you know of anything in the Blue Ridge Mountains in Georgia, that's where I'm looking. So
Yeah,
watch
let me
out.
tell you, there are a lot of people, and in our Mighty Meetup virtual groups, there's a lot of people that are a lot of wholesalers that are in that group in mightymeetup.com. And so, if you're watching this, you're not already a member, go to mightymeetup.com. It forwards you right to the Facebook group. A couple hundred people in there, only investors, no forex traders or anything. People selling Amazon jobs. Okay.
It's crazy how many there are. They're everywhere.
It's insane. It's insane. I don't know how they do it, but good. So yeah, finding deals, relationships. That's probably the most popular answer people give, is because you create a relationship. People know that you're a serious investor. They're going to send you good deals.
Right.
Like you're not going to get a whole lot of deals from someone you trust in a relationship that are just trash deals.
Exactly.
Right.
Exactly.
They're going to be good deals. Something at least worth looking at. So. All right, and then what do you use any software that makes your life easier?
Probably Zoom is probably the biggest thing that makes my life easier. I mean, you can do everything from anywhere nowadays. And I mean, I was using it a tremendous amount before the pandemic, because a lot of what I do is remotely anyways. It's just about conversations and podcasts and stuff like that. So that's one thing. And Calendly is tremendous. I mean, just having a calendar app, it's crazy the amount. I mean, literally my calendar is full, literally like 2 weeks out, and just people finding me and booking a conversation with me.
Yeah, I love it. Yeah, definitely. We're going to include all those links in the description too. If you guys are like, hey, I need a feasibility study done on my property, right? They reach out to you.
Yeah, absolutely.
So, all right, what books would you recommend?
So many books. I'm not a huge reader in terms of business books, but the ones that have been really good for me is, I'm a big fan of Gary Vaynerchuk and his processes, his strategy in terms of marketing, social media especially. So one of the best books I would recommend is Jab, 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 Right Hook, which is all about just adding value. It's all about how can I add value as much as possible, and then ask, if it even comes to that. But really, it doesn't even need to come to that at a certain point.
Yeah, I'm learning a lot more about that recently with different people that I've read books of or listened to I use Audible a lot.
Sure.
And I listen to these books, and I'm just like, about providing so much value that you almost have to trust in humanity to a point where you don't expect anything, but also you don't care.
Exactly.
You're just trying to provide value and help them, and it'll come back or it won't.
And it does. Believe me, if you sincerely do it, and it is a bit of a mindset shift if you're not built like that. If you're not an altruistic person to begin with, it's hard. But really, that's what it's all about. I mean, that's, in my opinion, that's what life is all about in general, and business works just like that. I mean, you don't need to do any sales if you are just adding value and providing value to people. It will come to you. And I think that's what Gary Vaynerchuk has really built and kind of emulated, is just building that community, adding value, and seeing the incoming people coming to you. And that's really It's so true. I've
Yeah.
seen it myself.
Yeah. Come to their level, find what they need and go for it. I love it. I love it. Okay. So, what is the greatest advice you've ever received?
Greatest advice is probably, eat fruit.
Eat fruit. That's,
It's a
I mean,
li-
I love that. I love that. I had a math teacher that was also the wrestling coach, and he only ate fruit.
That's interesting. No, I mean,
Yeah.
it's kind of comical. I mean, obviously not business advice, but just be healthy. I mean, if you don't have health, then you don't really have anything,
Nothing.
and so that's kind of combined with that.
Yeah, I love that. Yeah. Yeah, it's so true. The I forget what the ladder is, but yeah, if you don't have health and then wealth means nothing, dying on your yacht, like you're miserable on your yacht,
Yeah.
it's not going to take you anywhere. Okay. And then what is your parting piece of advice for my mighty nation of investors?
My parting piece of advice is to go out of your comfort zone. Do something today that you've been putting off. Okay, that you've been saying, I'm going to wait until this certain period of time, or I'm going to wait until X happens to do something. If you've heard some good, if you've learned something new that you've been waiting to apply or to implement, something simple, even if it's like, posting on social media, even if it's like making a phone call, whatever it is, just do it. One thing. And believe me, you will thank yourself later.
I love it. Half the battle is just showing up.
Exactly.
Yeah, and if you're sitting there waiting to post and you should post and it makes sense to post something on social media or even finding deals. I had one friend, Bobby Sharma down in South Florida. He actually said, I could have went and watched a football game. His friends were watching football or whatever, and he's like, I thought instead I'm going to go find a deal. I'm going to see if I can find a deal before the game is over, and he did, and he actually closed on it that evening. I'm just not closed, but got it under
Under
contract that
contract.
evening, and I'm just like. That mindset of like, could I go watch TV and binge Netflix or could I go get a deal?
Yep.
It's powerful. So what is the best way that we can that we can all keep up with you, and then we'll say goodbye.
You can follow me on LinkedIn. That's the place I'm most active. Definitely, I'm on all the socials, but find me on LinkedIn. That's the place I'm most active. Or you can go to yonahweiss.com. Either way.
Very cool. Very cool. Yonah, I appreciate you coming on. And I want to personally thank you for being on the show. I've been impressed with everything. The knowledge is just like, the idea that you could stop giving the IRS all this money and actually keep it for other investment deals is just genius.
That's awesome. Yeah, I appreciate you having me on. It's been a pleasure. Been a lot of fun, Mike.
All right. Until next time, Mighty Nation, go check out the website. I got it going across the bottom there. And don't forget to subscribe, rate, and review the Mighty Mike Show on your favorite audio platform. You've heard that you are the average of the 5 people you spend the most time with. You know this. All right. So go flex those inspiration muscles and build your network so you can build a mighty network. We'll see you guys on the next episode. Thanks, Johan. See you guys.